you can't delegate your wealth building to a financial advisor. You can use them as an advisor. They are an advisor. They are not your, hey, this is what you're supposed to do. You have to make that decision for yourself. And so you got to understand these various asset classes. And by the way, if you don't understand it, you steer clear of it immediately.
Today, we're diving into real estate investing and how to keep more of the wealth generated by your business. I'm joined by Marcus Crigler, the founder, CEO, and CFO of BEC, a company that focuses on accounting, tax strategies, and fractional CFO services for real estate investors and entrepreneurs. BEC aims to optimize its clients' cash flow and navigate market uncertainties. Just to be clear, a CFO is a chief financial officer. Different from a CPA who does more accounting and tax services, a CFO looks ahead and helps businesses with their cash flow accounting looking into the future. In our conversation, expect to hear current shifts in the capital markets, the kinds of real estate investments entrepreneurs should focus on for safety and stability, the pros and cons of all cash investing versus financing or debt leverage in today's market, the 4 financial phases every entrepreneur must go through to build wealth and keep it, why CFOs, again, that's a chief financial officer, are handy when scaling a business, why knowing where to put your money before exiting your business is a missed opportunity for most, and much more. Please welcome Mr. Marcus Crigler.
Marcus, it's been a little while since we had a chance to do a podcast and have a conversation, but you and I have had the privilege of knowing each other for quite some number of years, and I've watched how you have grown in your own realm of, I just call it financial prowess, with your background and the people, the customers, the clients, the companies, the real estate entrepreneurs that you help navigate their cash flow management. Obviously, you help with accounting and taxes, but it's really the cash flow management and helping them look ahead, which is what a CFO does. Look ahead and see where some of the hurdles may be. We never know. We don't have a crystal ball. Nobody does. But what I like about the fact is you get to look over the landscape. That's why I look at someone like you. You get to see the landscape of a lot of players, a lot of people in the entrepreneurial business ranks, again, particularly real estate, and see what's going on. From my standpoint, a lot of my listeners are not operators. We like to invest in intangible assets. We like to invest in real estate, but we also like to know kind of what's going on. But we don't have the same sense that you do. So let me just start with a kind of a global picture with all that intro and ask you, what are you sensing in the capital markets, and how are you advising some of your clients in terms of being proactive, hedging, instead of being reactive to changes that may come that we don't know when, timing-wise? What's a general sense that you see and forward-looking?
Yeah. So, well, I think people are very hesitant right now, to be honest with you. And I say stagnation, but a lot of that has a certain connotation to it. So I don't like utilizing that term. But the reality is people are cautiously optimistic, cautiously optimistic, but at the same time, emphasis on cautious, right? And so I think, we've seen a lot of movement in our government over the last 30 days, right?
Yep.
We've seen a lot of movement across the nation in the last 30 days. And so while, you may or may not like or agree with what's going on, we still don't know what the actual effects are going to be. And so I think what we're seeing a lot of is people still kind of sitting still, keeping money in safe spots, keeping it in safe locations, and waiting for what's going to happen, whether it's, hey, we don't go down, some of the projections that, hey, we're going to go down. We've got a huge crash that's imminent. The government's not going to solve any of these potential issues that we see in the capital markets right now. And then there's, the option of, hey, we keep going, right? And, we've had this projection or prediction that things are going to fail and you're going to have massive issues in the commercial markets and in these areas. And we've been looking at that for a long time, and it hasn't come to fruition yet. So it's kind of an interesting place where nobody knows what's going to happen. And so nobody's making any huge moves, or at least I say nobody. Most people are kind of just making simple moves, not trying to go for any home runs, certainly right now.
So let's talk in terms of a little bit more granular in the real estate markets during up markets where cost of capital was cheap a number of years ago until the last 2.5 years. It was a go-go market, right? Like
Sure.
everything was going up. Financial markets, real estate, capital markets, all going up. So it was get into equities, grow. Use debt leverage because that's where you boost your returns. Are you sensing almost a reversal of that right now, or how much of a shift or change? As you said, people are being a little more hesitant to, I guess, lean into what we've known in the past to be true.
Yeah. Well, I mean, I think you've got a lot of people, if you're thinking specifically real estate, and let's just talk buy and hold real estate in this specific example
Right.
here. I think if we're looking at that, I think people that were buying and holding real estate in the droves 2, 3, 4 years ago, they're not doing it anymore. And it doesn't matter if that's single family, multifamily, self storage. It doesn't matter because obviously the rates don't make sense with what the prices still are, right?
Right.
And so I think that's what we're seeing. I think that's what we're going to continue to see until there's some adjustment in rates. But I think we're I don't know what your opinion is, but I think we're mistaken if we think we're going to see any rates that we saw back in the
Right.
2020s, 2021s, 2022s. I just don't think that's realistic
Yeah.
anytime soon.
Yeah. I would agree. So, in light of that, and you work with lots of clients, have for many, many years. Are you seeing some clients that are shifting their models to any degree based on their sense of this uncertainty and what worked, 4, 5, 6, 7, 8 years ago? Not so much today. Are you seeing some model shifts? And if so, what kind of general model shifts are you seeing or not?
Yeah, I guess it depends on the client, right?
Hmm.
So all of them have shifted their model in some way. I guess the question depends on the extent of which they are shifting their models. A lot of um, I deal with a lot of operators. So a lot of people that are in the wholesale fix and flip, you know, moving single family properties at quantity, right? And so those operators, a lot of those are shifting to how long they're owning those properties. So
Hmm.
maybe a property they would have flipped 3 years ago, they would have borrowed private money to flip at maybe a reasonable interest rate. Interest rates are higher on private money, and that flip is more risky. So they're going to just turn it. And instead of making 50, they're making 30. But that risk is a whole lot less. And the cost of capital is a whole lot more on some of these deals. And so what you're seeing and what I'm recommending is that we reduce our time of hold of any property, right? And so whether it's a fix and flip, if they're still a company that needs to fix and flip, we're looking at much smaller renovations where those renovations are maybe 30 to 60 days instead of 60, 90, 120 days. Because again, we don't know what the market's going to do, and we know it can shift fast. So I don't want my clients owning anything that they don't think they can get rid of, right? And so we want short-term assets, or I want them to buy something that they have a ton of equity in and they don't
Hmm.
have to get rid of it anytime soon.
Right.
And so that's the other shift that we're seeing is that the amount of equity we used to see as a requirement in a property to buy is substantially more now.
Hmm.
You could cash flow potentially a property by having 20% equity in the deal.
Hmm.
You can't today.
Right.
Costs are too high. So you might need to have 30% equity, 40% equity, 50% equity. But not only that, the cost of that property, but the risk of holding that property is there still too, and it's a higher risk. And so what we're seeing is if they don't have great equity, and in today's market it doesn't cash flow reasonably, we're moving it and we're dispoing it. And currently, we've been fortunate enough to be able to continue to dispo those properties.
This dispo for people who don't know is dispose of, sell
Yes,
off. Just so we're clear.
get
All right.
rid of,
Get rid of. Yes. Yeah. Yeah. Move it. Okay.
preferably for
So
a profit.
preferably for a profit. Yes. Okay. Very good. Here's my special request of you, my avid and loyal and faithful listeners. Of the thousands of listeners I've had in 2024, less than 10% of you are subscribed to the podcast. That means 90% of you are listening to my podcast, and yet you're not subscribed. Why not? Well, it's just because you haven't taken the time to do it. I know I get busy to the same thing, and I fail to subscribe to the content that I like. So if you enjoyed or found my content helpful, clicking the subscribe or follow button right now will help the algorithms push my content to more people who can find it just as valuable. Plus, if you are a subscriber, you ensure you won't miss any of my content or updates as soon as they come out. I am personally excited about the upcoming guests, books, and projects that I'm working on, and sincerely don't want you to miss out on any of them. So hit that subscribe button. Stay tuned for more. Now, back to our conversation. Okay, so here's something that I run through my mind, and I know the pushback on this, but it still comes to mind that, like, why couldn't we? And when I say we, I'm not an operator, but we just talked about the high cost of capital, prices. In general, the bid is still too high, so we have to see some equilibrium. Either interest rates, got to come down, and to your point, I don't think we go back to the days we were in. Prices got to equilibrate. Something's got to happen there to make it happen. What if an operator? Now I know this is the big what if, but what if the operator went into deals? I know they're having to today because the banks will underwrite, 20% down or 25% down. It's probably 35% down. You know better than I do, but it's a higher amount of equity has to go into a deal. It's hard to raise equity right now. I get it because of the uncertainty. But that being aside, why couldn't I, as an operator, position myself as like the guy that I personally like, David Phelps or Marcus Crigler, might invest as a passive LP investor if we were going into a very low or maybe even no debt ratio, debt financing. Now, I know you're going to say, well, yeah, the problem is raising that capital, David, because, I mean, you got to use debt leverage to make the money go further. Okay, got that. And also, we can't give the same returns because when you're not using leverage, well, now we're just going to what's the cap rate as an operator? Well, today, I mean, can we get, 7.5, 8, I mean, without a big value add? But what's your thought about that? I know I never proposed this to you, but I'm sure you can roll this in your head pretty fast.
Well,
Is there anything there that would be, if you could raise that kind of capital to go do it today, or do you think that wouldn't sell?
when you say, okay, so just so I'm clear on the question, basically you're saying if somebody were able to raise the capital and go pay cash instead of
Yep.
using any bank financing, we just use all private money.
Yep.
Don't quote me on this, but I believe that's what Grant Cardone's doing. If you
Is
go
he?
look at
Okay.
what's that?
I said I didn't know. Is that what he's doing? Really?
Well, I can tell you that over the last 5 properties, he has paid cash for those last 5 properties. At least that's what he has said publicly. My
Okay.
guess is that means he raised capital to go pay cash for those. They're $50-100 million properties. They're huge
Mhm.
properties, and so he's deploying that strategy specifically because he can't get the bank financing. There's not enough good bank financing out there for those properties.
Mhm.
He just rather buy the properties cash and then move. Now, he's also getting them at probably good discounts for being able to
Right.
buy them in cash. And so, can you take that model
Mhm.
and can you take some zeros off of it and go deploy it in your own market? Absolutely. It is the complexity of how do I raise capital at a lower rate? Because your
Yeah.
probably best bet is going to be, you know, I'm a big believer in overperforming, under deliver, or underperforming, over delivering. Right?
Yeah.
I think I said it
Under,
wrong, but
yeah. Well,
you get my point.
under promise, over
Under
deliver.
promise,
Yes.
over perform. Yeah.
Right.
So you're going to probably have to raise it at 6%. Maybe you could get them 7.5,
Right.
but you don't want to tell them 7.5 because it's going to be tough to do that if
Yeah.
you're not taking on debt.
That's right. That's right.
But that is the business, right? I mean, every market has its own complications.
Yeah.
And so in 2020, there were problems. It wasn't just perfect, right? There was so much competition out there. Prices were going up so fast. Nobody was able to predict what the sales price was. There was plenty of issues. This is just another issue that needs to be solved for. The great thing is it can be solved for, right? You're going to have to get good at raising money. Maybe being in an organization like yours can help solve some of that problem too.
Well, that's a discussion for another day, but that's kind of where my head goes on some of these things. I mean, we're problem solvers, right? And the disruption in the markets provides opportunities to solve problems in a different way, and I think that's the fun part of what we get to do in different ways. So,
Yeah.
all right. So, one more question, kind of about operators, and I want to go to a few of the frameworks that I know you're really good at talking about. Uh, in general, again, operators' balance sheets. I'm sure there's a spectrum, but overall, do you see, and and hopefully your clients do better because you're there, pushing hard on them to clean up their balance sheets and create more margin. But have you seen a shift in that direction, or are you seeing people accepting the fact that they need to slow it down, be a little more reserved in general, or what? Or you get pushback on that from people like, no, you don't understand, Marcus. Interest rates are going down. We need to go harder. I mean, I'm just curious, what's the sentiment, if there is a sentiment?
Yeah, I mean, I think 100% everybody has shifted their focus to the balance sheet. I think you hit the nail on the head there. When things are great, everybody likes to stare at the P&L, right? Because it looks pretty. But what happens is the balance sheet is what creates the problems. It's never the P&L. The balance sheet is where most of the problems are at because you lose cash. Cash is
Right.
the biggest piece of your balance sheet. And so, yes, from that perspective, every single one of my clients, and we've been focused on this for not just today, but since 2020, when we saw the
Mhm.
writing on the wall that this isn't going to last forever. Hey, we've got to stack cash into this business, and we've got to focus on our current ratio. And you've been in my presentations before. We talk about the current ratio all the time, which for those of you that haven't ever heard of it, it is just simply a liquidity ratio that tells you how liquid you are in your business. And so we talk about the current ratio a ton, and what we focus on in that is helping them improve their current ratio, improve their liquidity. And so if you're asking what the market's doing, I think the
Mhm.
market is absolutely focused on improving their balance sheets by putting more liquidity on their balance sheets. Now, how successful they are at doing that, it's a person by person experience, if you will.
Yeah, no, I get it. I get it. All right, let's go to some more general applications for wealth framework. And you've laid out in the past. I've heard you. I've seen you post some really good models in terms of like a wealth framework process. Uh, we can think through this together. There's a hustle phase. We get out and we hustle. Right, we're out there grinding away, trading time for dollars, just building up steam to create something. We go to more of a stable or secure phase. We've got a little bit more to cover the next month. We're not fighting to pull ourselves above the waterline. We've got some level of stability there. And then that's the time when it's like, okay, I've got things feeling relatively secure. I need to grow. I want to expand my empire, my enterprise, whatever that is. And then years down the road, it's like, okay, I'm ready to slow it down. I want to exit, take my capital, take my equity that I've worked so hard to build all these years, and move it. You want to expound on any of those a little bit in the way that only you can do?
Yeah, well, so that is kind of the wealth creation framework, right? If
Mhm.
you are, and that's for entrepreneurs. Certainly, if you are not an entrepreneur, it's a similar process, but it's a little different because you're getting a W-2 wage. But ultimately, everybody's got to go through the same process, and very few are the exceptions. So you've got to hustle, right? You start out in this business, whatever the business is. Ultimately, that hustle phase is all about focusing on that balance sheet, getting your product together, getting getting yourself positioned, getting the right cash in the bank, right? That there's a whole process to making sure you've got the right cash, the right debt, all of that, and get your balance sheet together. But then you go to the secure phase. A lot of people, they go from hustle to expand,
Mm.
and they forget about the secure phase. And the secure phase is maybe the most important part of your journey as an entrepreneur, because this is the spot where you prevent yourself from going backwards. And if you're an entrepreneur, you know what I'm talking about. If you want to be an entrepreneur, you want to stay away from going backwards, because that's the thing that ruins your ability to grow wealth, right? Anytime you go backwards, it just takes years of wealth building off of your plate. Our goal is to be slow, right? We don't have to be fast in growing wealth, because we know long term, if you go slow long term, you'll get to your destination, right? And you can do it in a lot faster pace than if you end up going backwards. And so we go from hustle to secure. Secure is a very, very important spot. And then you go to expand, right? And expand is where you start to invest, right? Invest in people, invest in
Mhm.
advertising, start to really get to where your goals are, right? And start to improve your business, improve your softwares, improve your technology, make your business to where it is an asset, right? It is an asset, so that when it's time to exit, you have a true business to exit from. And no matter what your business is, every business is going to have an exit. You can either exit voluntarily or you can exit by design. And I will tell you, if you exit by design, you're going to generate significantly more wealth than if you exit voluntarily. And so going through this process allows you to get to a spot where you can exit in your manner, the way you want to do it, so that you can actually generate the wealth that you want to generate in your life.
Marcus, what do you see as some of the biggest mistakes or errors in judgment when one is in the secure phase and desiring obviously to expand, but going too fast? What are some of the key things you see that sets them back to take those two steps back before they can actually really go and expand the right way?
Yeah, I think generally what happens is we get into that hustle phase and we start seeing a little bit of that future cash coming in the bank, right? We can start tasting that ability. And what happens is instead of going and investing in things like making sure your bookkeeping is squared away, making sure your LLC is documented appropriately, making sure you've got the right insurance in place, making sure that you've got a tax person in place. All the boring stuff that we don't want to do as entrepreneurs, we forget about it all. And then we go straight into the expand phase where we don't have the backbone of a business yet, right? We've just made a little bit of cash, but making cash is not running a business. Making cash is simply just a good hobby, right? It doesn't turn into a business until you actually get to the secure phase and build that foundation around it. Have that cash in the bank. Make sure you don't have bad debt. We talk about bad debt in the secure phase as being debt that isn't paying itself off. Well, if you've been in this hustle phase in your business and you've been cranking out credit cards, or maybe you've taken out a personal loan or whatever it takes because we're hustling as entrepreneurs, in that secure phase, we've got to get that stuff paid off. And one of the big mistakes that I see people make is they go in and they don't pay that off and they go to the expansion phase and just create more debt. And it becomes such a huge debt cycle that a little hiccup in the expansion phase, like what we could be seeing, well, like what we saw in 2023, right? A little hiccup there in 2024. Now we go backwards and we go backwards to the hustle phase where we're just trying to get cash again. And it almost turns into a hobby again because we're not making profits and we're barely generating any cash. But yet we've got all the complexities of an expanded business. And it's the worst thing that can happen to you is to go back from expand to hustle. And that's when you start seeing layoffs. That's when you start seeing, vendors getting missed payments. That's when you start seeing, loans getting called, right? That's all of that stuff becomes a terrible situation. And ultimately, bankruptcy can end up in that area too. So that's why it's so important that you walk through that phase and you know where you're at in each one of those phases too. It's self-recognition of, hey, yes, I've been in business for a couple of years and I've made a little bit of money, but that doesn't mean I'm ready to go run a 25 person, corporation that is generating $25 million in revenue, right? There's steps to this thing.
I think that self-recognition is so difficult. And that's why I'm a huge believer. And here I'm just going to give kudos back to what you do. And maybe this is a good opportunity because anybody in any business, my belief today, and I didn't even understand this 20 years ago because I didn't understand what a CFO was. I didn't understand that I could actually hire a firm, a company, a person like you that runs a company, even on a fractional, a participation basis where I didn't need a full-time person, but just having somebody that could give me, the entrepreneur, the one who is spinning all the plates and has the vision and I want to hustle and do all this stuff, to say, as you said earlier, great, David, you've got a great model here. Good job getting to here. But let's set the infrastructure. See, I need that. I need someone to slow me down, put some governors on, say, good job to here. But as you said, before you expand, we've got to build a few more pillars in the foundation here. Yeah, as an entrepreneur, I don't want to hear that. I want to hear you say, yeah, David, put the gas to the pedal to the metal. Let's go, baby, go. But reality is, with some time and experience in the field, and you have tons of that by helping other people, I think the key is, so we'll give people just a little bit, because again, I have all kinds of people listening to us today that are, whether they're in real estate or just entrepreneurs in other businesses, or my doctors and dentists in professional practice, they all need to know what you do. Give them a little bit of a sense of what you bring. I like to term it like a dashboard for dummies, for visionaries. What you can take all the numbers and siphon it down for me and say, all right, David, you don't really need to dig in deep to all these numbers here. I'll do that for you, but I'm going to give you the key numbers and metrics, and we'll have some. I don't know, green is good, yellow is caution, and red is not good. I mean, that works for me. And then if there's yellow or red, you'll take me down the rabbit hole and go, okay, let me explain why this is happening. So can you elucidate a little bit on that and why the services that a good CFO provide is so important, going from that secure phase to the expansion?
Yeah, I think so. I think it's important to understand what a CFO does in your business, right? And what a CFO is for. And when you are looking at growing your business, and it's imperative that when you're thinking about hiring that CFO, you're hiring that person because you are looking to grow. A lot of people, might not be in that growth mentality, might not need that additional CFO. But we're talking about if you're looking to go through those hustle phases, right? Hustle, secure, expand, exit. And what you're looking for in that CFO is not somebody that looks at hindsight, what happened. You're looking for somebody to give you insight into what's going to happen, right? And so, what I mean by that is, as an entrepreneur, you don't need somebody to sit down and look at your P&L with you and walk through, a CFO to sit down and look at a P&L with you and tell you, here's how much you made, here's how much you spent, here's the net. You can do that with any accountant, a controller. That is a perfect job for that role. But a CFO is going to look at your business and help you strategize from that hindsight information to make insight decisions on where you're going. Where is the revenue trends going? What should we be investing in? Do we need to hire this person? What does it look like if we put more in marketing? What does it look like if we hire that CMO or CE or, CFO, right? What does it look like if we hire those people? What are the costs? What are the projections? How does that look in your business? And so that's a big piece of it. The other side of it is tracking your KPIs. And you mentioned it, having a dashboard in green, yellow, red. We do that 100% of the time when we have a CFO client, because our business is so complicated when we really think about it. When you think about any business, there's a lot going on in a business, and we've got to figure out a way to get an entrepreneur to understand what's going on in their business in a few numbers, right? We only have so many numbers that an entrepreneur is willing to look at. And so what we look at is, how do I get a KPI dashboard so that they can understand the key numbers that actually matter, and then everything else is noise, right? So if they need to go solve a problem, they can see that KPI that is creating the problem, and then go solve it. And that's how we look at it. And that's what a CFO is there for, right? Is to help you point out those problems. Now, a lot of people look at their CFO to solve the problem. They're not solvers. You are the business owner, right? And so as the business owner, you're taking the information and you're making decisions. And so we talk a lot about better decisions, better results. If you as a business owner can utilize that CFO to help you make better decisions, that is ultimately what you're going to get, is better results. And that's the key responsibility of that CFO.
Yeah, I look at it as, you're the diagnostician. You can look at the numbers, you can ferret out, like a doctor does, looking at a patient's x-rays, blood work, that chemistry, and say, okay, we've got green, yellow, red, and you can tell me, leading, lagging indicators, historically, and then projecting, metrics that we can look at that haven't actually turned into a result yet, but there will be a result, and can give me that as an entrepreneur. And from that, then, as you said, it's my job to make decisions, but at least I know what I make decisions about, and not just, guessing. And do I expand? Do I hire this? Do I do more market spend on 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 marketing, or just, where do I need to put the money? That's the key. And I think as entrepreneurs, so many times when we're young in career or business, we are guessing, we're flying blind, and that just doesn't work. So I always talk to people about the difference between an investment and an expense. And I look at people like you as an investment. That's not on my P&L. I'll grab from my balance sheet, go hire a Marcus Crigler because that's an investment in my future, not an expense. Utilities, something like that. That's my expense. Okay, it is what it is. But I just like to people miss that so many times. People think, well, if I'm not investing in the stock market and real estate or precious metals, I'm not investing. No, you're investing in yourself, or you're investing in something that's going to add long-term results to your net worth, equity, business, whatever it might be. That's how I look at it. Anyway, you're making that point. I just want to nail it there for a minute.
Absolutely.
Let's let's go for a minute to the exit. An entrepreneur has gone through the phases, expanded, running well, and it's time to exit. And maybe this is not a legacy play to the next generation. It's just we're going to take chips off the table,
Yep.
sell out to another buyer. How many times do you run into, or what's your general sense of entrepreneurs who've learned their craft, learned to be good business people, but then when it comes to take chips off the table, they're kind of lost. It's like, okay, I've always had my hands in my business for the most part. That's where my predominant equity's been, and I've ridden that horse and I've done a good job. Now I'm going to take it and put it somewhere else and be like, a passive investor, so to speak. I can put it in the stock market, and I'm not making a play, yes or no. You can certainly do that. I'm a big fan of today, and we talked about earlier today on the calls, why probably hedging and more diversification is important. So if I've never really done that outside of my primary business, what should a business owner entrepreneur be doing along the way to maybe develop more, let's just call it generalized financial acumen?
Yeah. I think it's so important to be a continuing learner, right? I think that's
Mm,
number one. I think if you are great at what you do, that is phenomenal. And that is your golden ticket to financial freedom because you only have to be great at one thing. However, on the other side of this, you do need to get good at managing money because if you're going to make it, you got to get good at managing it. And so that's your next skill that you're going to have to figure out. And part of that is understanding the various investments that are out there to manage and understanding what a diversified portfolio looks like. And you know, you're a lot of you maybe some of your listeners are like, well, I have a financial advisor. That's what they're there for.
mhm.
Unacceptable. You can't delegate your wealth building
Nope.
to a financial advisor. You can use them as an advisor, right? But
Yeah.
they are an advisor. They are not your, hey, this is what you're supposed to do. You have to make that decision for yourself. And so, it doesn't matter if you like Bitcoin, if you like real estate, if you like stock market, if you like whatever your thing is, if you got to understand these various asset classes. And by the way, if you don't understand it, you steer clear of it
Right.
immediately, right? There's no asset class where you want to get involved with that you don't have an in-depth understanding of that asset class and what it means to you, both on an income standpoint and a tax standpoint, by
Mm,
the way, right? That's another thing that a lot of people miss out on is they don't understand, not just a lot of people get the after tax returns. Okay, what's the after tax return? That's not what I'm talking about. I'm talking about, do you even understand how the tax information is going to get reported to you? Do you understand that when you get depreciation on a syndication, that you got to pay recapture when you sell that asset?
mhm.
Do you understand all of these things? And if you don't, you've got to kind of stay clear away,
Yeah.
stay clear from it. So that's what my biggest recommendation is. And I do see, to your point, David, is that it's something that what I find is that people that are in that exit phase that are truly exiting, right? It's a nerve wracking. It's a completely different skill. It's 30, sometimes 30, 40 years of the same thing. And now I've got to develop a new skill that is
Right.
completely outside of what I've done my whole life. It's tough. And not
Yeah.
and it's so much change. And quite honestly, I believe that's why so many people stay doing what they're doing because un they're afraid, to be honest with you, to get that new knowledge, to get that understanding of, hey, I can sell my business and then I can go invest it here and I can get comfortable with making that kind of money. And we talk about being financially free and being able to do what we want when we want to, but sometimes we're too afraid to actually take the leap to do it because we don't know what's next.
Yeah, you're so correct. I see it all the time. It's not that we or the people that have run great businesses don't have the ability all day long, or they wouldn't have been done what they've done. But you're right. There's been so much focus on the one thing and getting really good at that one thing. But now it's a different skill set, and I think that's a big reason why I see so many hang on when they're physically and emotionally spent, because
Yeah.
it's the safety net. And as long as I can hang on to, let's kind of hang on that horse as long as you can, because as soon as I drop the reins, I'm going to be kind of drop dead here right in the trail.
Mhm.
It's not comfortable hanging on because it's a bumpy ride, but man, if I let go, where am I going to be? It's that fear of the unknown. And I think you hit it right. It's a scary point to be. And I'm a big advocate, as I know you are, about always developing additional skill sets outside your primary area of specialization, right? I mean,
Yeah.
we have to these if you can call if you want to call financial acumen a soft skill. I don't know if I call it a soft skill. I think it's a skill that everybody needs to have at different levels in life, starting with young people, right? Which our education systems, typically been terrible about
Yeah.
teaching any basics there. But as we climb that ladder in our own success in our own career, uh, adding some dimension of, as you said earlier, how can I manage my money outside of my business? When it's time to start managing money outside my business, how am I going to do that? How am I going to allocate? Yes, use advisors, get help.
Mhm.
But if you don't take control of your own money, no one's going to do it like you are.
No, absolutely not. And it's scary, right? It's scary to allow somebody to have that much control without
Yeah.
your understanding and agreement of it. And so I think it's just very, very important that if you're somebody that you're in the expand phase, that's a perfect time to, as part of your expansion, is to be thinking about what is that exit phase look like, right? And you might be in the expand phase for a decade.
Mhm.
That might be the deal. But if you're in that phase and if you're truly in that phase, you've done the hustle, you've done the secure, you've got your foundation built, you're not going backwards, right? We know those businesses, yeah, they might not have the revenue one year that they had in another year, but they're still going to generate profits. The owners are still going to get paid. It's a solid business, right? It's going to take some massive adjustments for that business to not be a great business. Those types of business owners really need to be also spending some time understanding these various investments that they could be getting into.
This is great. So I'm going to close this out here. I'm going to make one last point, and it's going to sound a little self-serving, but you're going to get where I'm coming from, Marcus. So to that extent, for all the entrepreneurs that I serve, you serve, other people serve, that are doing great things in climbing the ladder from security to expansion phase, and living life with purpose and creating financial wealth that someday will let them have the choices of freedom. That's what we're all about, right? Doing it by yourself, I think, is the biggest mistake. And again, this is something you don't learn in school, uh, but we both know that being associated, being intentionally affiliated with, participant in different kinds of groups, coaching group, mastermind groups, whatever it is, that's where you and I met. Is you're doing it with other people that are also on the same journey, the same path. Could be totally different businesses. It doesn't matter. It's the mindset of somebody who might be a little bit further down the path than I am. Maybe it's age, maybe it's maturity in business, but I'm looking and saying, hey, that person's speaking about something that I've always thought about, but I haven't done that. And maybe I can glean some wisdom from that person. When did you start learning about this? When did you start divesting? When did you start doing this? If I don't have that exposure to other people who have maybe gone before me and figured a few things out, then I'm living in a vacuum. And then and that person who just kind of trips along, and every time I get to a new milestone in my elevation, boom, I hit that ceiling. Like, what do I do now? It's like you've got to be ahead of the game. I don't know. I'll let you speak to that and finish it off, but I know what you're going to say. You're a fan, right?
I think you know we've all read Think and Grow Rich. If you haven't, put it on your book for 2025 book list for 2025 to read, and it talks all about it. Right? It talks about understanding the importance of a mastermind and understanding. And if you're not familiar with what a mastermind is, it's exactly what David was just describing. Right? A think tank, a group of people that are coming together to help each other win. And whatever that looks like, all masterminds are created a little differently, but they're all equal in the sense that, hey, you've got people coming together that are trying to help each other in their expertise in their life, right? And it could be, hey, I'm a couple years advanced from you. I've been here, done that. this is the step you need to take right now. Or it could be somebody like me, right? That, hey, I've got 200 entrepreneurs that we work with every single day in all these different phases. I'm seeing all the problems. Come ask me. What questions do you have? What issues do you need solved, right? And so you get all of these people into a room and this think tank. It creates some really magical things for your business. And what it does is it challenges you as an entrepreneur. It makes you grow as an entrepreneur. Not necessarily as a business. You have to figure that out yourself. But as an entrepreneur, if you get into one of these masterminds, and if you get accepted to some of the great ones in the country, I can promise you this: you will absolutely grow as an entrepreneur. And by doing that, you will get to that wealth goal faster. There's just no doubt about it.
That's it. In a nutshell. Well, Marcus, it's always great. Thanks for coming back on and just bringing some of your insights and wisdom. I always love talking to you, and I know our listeners do too. So really appreciate your time today.
Oh, anytime.
Some of the most common mistakes I see that real estate investors, entrepreneurs are making today is really a lack of a knowledge of a full market cycle. It's oftentimes that I see people get into a certain mode or modality of operations in a market cycle that produces a lot of tailwinds or a lot of motivation and movement going forward that allows certain people in certain business sectors, or in this case in real estate, to make a certain model work well. For instance, the last 15 years, really going back to coming out of the 2008 financial crisis. After that downturn, that correction, everything has been really uphill ever since. A lot of it manipulated by the disruptions and distortions in the financial markets, the monetary policies and the fiscal debt spending by our government has really front-loaded a lot of capital that has pushed asset prices up. In that kind of a mode, it seems like everybody's a genius and everybody makes money. The problem is when we go through a cycle change, a turn, a downturn, a movement in the other direction, most people that have had good results in the previous half cycle don't know how to maneuver the forward-going cycle. So I see today a lot of entrepreneurs are still using a model of buy the properties, buy the equities, debt leverage with higher cost of capital is a problem today. And because prices have not equilibrated to the higher interest rates so far, people who have a model that worked in the past are finding they have less margin today by a long shot. Still trying to squeeze profits and cash flow out of models that really don't have it. And all it takes is just a little problem like higher property taxes, higher insurance, higher transient vacancies and turnovers in their properties, moratoriums on evictions, which we had happen during COVID, natural disasters that happen. All of these things can happen in a normal scheme. You've got enough margin to deal with those. But in a market like we have today, where too many profits are trying to be squeezed out of a model that doesn't really provide that, it's a big problem. And I think that's where entrepreneurs that are boots on the ground and investors who love investing in real estate have got to be really cautious today as to how you invest. There's many models of investing in real estate, and equity ownership with debt leverage is just one of those. I think today is a time to be cautious about that model. It will come back again, but right now, I think it's a good time to really be prudent and take time before staying with a model that maybe worked in the past, but is not so relevant today. For business owners who are at the point of exiting their business or their professional practice, taking the chips off the table, harvesting that equity that they maneuver for so many years, made the income for their family, supported them well. It's a transition time for sure. It's an opportunity to phase out from active income into more of a leisurely retirement phase, if you want to call it that. That's something that most people look forward to at some point in their life. Here's the problem. When you've been operating your business, your net worth, your equity in that business with your hands on it, because you understand that business, you understand that professional practice, you make all the decisions. Yeah, it's work, it's active income, but you're able to keep your fingers on the pulse, your hand on the gears or the levers, so to speak, and maneuver those. When you sell out of that business, now you have your equity out from under the business, and now it's in your hands, so to speak, figuratively. It's in your hands. You've got it in savings accounts, bank accounts. Maybe you put it back into the financial markets. Not sure where you put it today. That's the problem, is where do you put that equity? Because you're used to having it produce regular, sustainable income and also a growth value aspect as well. Now you're in a position like, well, what do I do with it? Where do I go today? Well, today the marketplace is at all-time highs. Equities, we're in a bubble. Do you put it back in a bubble market with the high degree of chance that that bubble is going to burst at some point in the near future and reduce your principal, your equity by 30, 40, 50%, don't think that's a good move. This is a problem because when you don't know how to navigate your capital base outside of your business, got problems. This is a set of financial acumen models that need to be learned while someone's in business. If you wait too late until it's time to capture that equity and now figure out what to do with it, you've never done it before, except just putting it in a 401k and letting a money manager manage it, not a good look. I really tell people that it's imperative that you learn how to make money work for you on a more active basis, similar to what you've done with your business equity. I like to be what I call actively involved with my passive investments. Actively involved with my passive investments means I'm not doing the work anymore, but I'm on top of where I'm investing my money and who the operators are, whether that's businesses, whether that's real estate, any of the tangible assets that I like today. I want to be involved. And I think that's what it's going to take going forward in the years ahead, because we're going to have a lot more volatility and turbulence. And just staying with an old model that might have worked in the past could be very dangerous for many. I'm often asked, can business owners sometimes hang on to a business too long and miss the opportunity to sell when the opportunity is there? Well, I think that does happen quite often. I think it's a fear factor that when a business owner feels like they are there at the place where they would like to exit, the question comes up, well, do I have enough? They've never again looked to see, well, how do I take the equity from my practice and make it actually produce replacement income? It's replacement income that's important. Yes, you've got to have an inflation hedge with that, but replacement income is the first and foremost priority when you're leaving active income. You've got to have the income. Otherwise, you're going to be taking your equity base and depleting it down over the years, which is the typical traditional model of financial retirement, which in my world doesn't make any sense. I like assets, like a business that will keep producing income and have an inflation hedge at the same time. Not really a place to be with the financial markets. They don't provide really, really strong dividends, so you have to be in a growth mode. Well, growth mode's great when you are in a growth mode, period, but when you need the replacement income, those growth stocks that work so well don't play out anymore. So where do you go? That's the problem. So yes, I think there's a window of opportunity when business owners should probably take the chips off the table, and they don't, because they're afraid, they don't have a plan, they've never laid this out in front of them in the past. That's a big problem. It's really imperative, again, I've said it before, that a business owner who's good in their business also starts to learn how to make their money, their equity work for them outside of that business. That's what I call Plan B. So what I started doing back before I actually got into dentistry, my business, is I started learning how Plan B works. And today, that's what gave me the exit that I had 20 years ago and lets me live my life really the way I want to, what I call work optional. I love what I do. It's not work. If there's nothing I'd rather be doing than what I do today, it's not work. I'd love for you to be in that same position in your life, but you can't do it without understanding how to make your money, your equity, work for you outside of your primary business. Most spend their lives optimizing for wealth, net worth, and quantity, thinking them the accurate measuring sticks for success or the magical portals into the lives they want. I believe most people are optimizing for the wrong thing. Time is the greatest resource, and time is what we all want more of in the end. But it's not just about the quantity of time, it's about how you spend it. How you spend your time is the most accurate measuring stick of the success of your life. So, how can you optimize your life, business, and decisions for more time? And how can you upgrade where you spend your time to improve quality and the satisfaction of life? My new book, Scaling Time versus Wealth, lays the groundwork for these questions and provides the lens through which you can filter your decisions to optimize for time and how you spend it. You can get your free copy at scalingtimeversuswealth.com. That's scalingtimeversuswealth.com. And thanks for tuning in. Be sure to click that subscribe or follow button and let us know what you want to hear more of in the future. I'll see you next time.